Well, thanks for having us on this presentation. I just wanted to say thanks to the TradingPub folks. I watched a number of the presentations throughout the day today, and really was impressed by some of the earlier speakers. So anyway, thanks for including us on this. What I'm going to talk to you guys, well, first of all, I'll introduce myself a little bit. I'm Aaron Eitenbrook. I'm one of the founding partners of i10Research, along with David. And what I want to talk to you about today is what you see right here, using volume at price and how it applies to the foreign exchange and futures markets. That's the bread and butter of what we do at i10Research. That's what we built this company on, and I think that some of the stuff I'm going to share with you today is going to really be interesting and useful for you guys. So with that, I'll jump right in. Here's a standard disclaimer. I think you guys have seen it multiple times throughout the day, and it is required. So i10Research, here's a look at some of our happy little faces. I'm Aaron. I've been trading for 15 years, futures and commodities, and equities and other options along the way. David and I have many varied experiences in the trading industry, both in the dealing with customer side as well as managing money side, and that's just a testament. When I think it's been said on here before, when you listen to somebody who wants to teach you about trading or tell you something about trading, it's always a good idea to have a good idea of what their background is and what they can do to kind of put their money where their mouth is. So anyway, that's what this is talking about. So how to manage risk in the foreign exchange and futures markets using volume at price. Well, first of all, volume at price, if you're not aware, I'll get into specifically what it is, but just so you know, volume at price can be used to identify specific trading opportunities. It can be used to design your trades with specific entries, stops, and targets. Using volume at price is objective and consistent in the analysis that it produces. It's objective and consistent in the way it's applied, and there's no confusion with having a conflicting set of indicators when you are doing a volume at price analysis, because you are analyzing market generated data, and if that's the starting and ending point, there's not going to be any conflicts between something saying the market's going up, something saying the market's going down, and you have to try to interpret that. Volume at price works in all markets and all time frames. It uses market generated information, and there's no expensive proprietary software involved. Most of the trading platforms nowadays have a volume at price tool. Trading platforms, charting platforms, they all have a volume at price tool. Some call it volume profile, some will call it volume at price. But the good thing about that is once you learn how to use volume profile, you don't have to pay up to have access to making that kind of analysis. So the crux of this presentation, if you're attending this this event, there's a lot of different caliber of traders. There's people, I know that there's new people and there's experienced people and there's people that are everywhere in between. But I think all traders can identify with the struggles of profitability, consistency, validity of a trading plan or a methodology where maybe you are certain or uncertain of whether what you're trying to do is even valid. When you're operating in the market, there's can be questions with which side of the market you should be trading on, and if you have that one figured out, then there's always the questions of where to take action and where to kind of update your analysis or update your decisions that you made previously. And both David and I, we were traders first and involved in the industry second, so we totally understand these kinds of struggles. And if you're confused, it's not your fault. That's what that says. And a big reason is because there's a million different solutions and a million different people vying for your attention that are telling you what you should be doing, and they're all singing a different tune, so it's very easy to not have any idea what to do. You probably tried a lot of these solutions, and my guess is if your experiences was like mine when I got started in trading, you are left wanting with most of the avenues that you go down. You go down a lot of dead ends, and it takes a while and costs money before you find out that in fact it was a dead end, and then you got to circle back and start at the beginning again. So the truth is, without valid information and a valid trading plan, it's pretty much impossible to get consistent positive trading results. And to what I spoke to before, worst of all, most of the information out there, if you're just Googling trading on the internet, there's very little real-world utility, or worse, the information that you're going to find, looking on the internet just or on internet chat boards is just downright false information. There's a lot of self-proclaimed gurus and experts that really have nothing to offer, but they are either really good marketers or they have a really good pitch, and that keeps them in business, but their methodology has nothing to do with actually making money for other people. So the number one thing of import is that in trading you must use a proven and valid trading method. You have to have a trading plan that is built around a proven and valid trading method. Otherwise, it makes no difference what you do second or third if you don't start with the number one. And at i10Research, we use volume at price analysis and auction market principles. And I'll talk more about this in a second, but like I mentioned before, this is 100% market-generated information. It's not using any kind of magic number series. It's not using some kind of hypothesis about the way the markets move. It's using the market's movements and the data generated by those movements to do the analysis and make decisions. It's objective and it's consistent, which in trading that's what you want. You want to be able to come back day after day and consistently and objectively apply your craft and get a consistent result. So at i10Research, David and I, after we founded the company just a matter of years ago, for the last 2 years, we have been doing the technical analysis commentary for Standard & Poor's Market Scope Advisor. That's an institutional platform that S&P has. They have 100,000 institutions, all around the world that subscribe to their Market Scope Advisor platform. And on that platform, they have a lot of ratings things and rankings things, but when it comes to technical analysis of the stock market, of the commodity markets, of the foreign currency markets, David and I hold down 100% of that technical analysis on their site. We send our analysis and opinions to New York no less than 3 times a day, and most days we send more than that. And S&P, besides being involved in S&P that way, we've been quoted on Fox Business News and been published in Barron's, stuff like that. This is just, validation of our work. Standard & Poor's puts out an investment policy committee notes every week, and they include our analysis and our forecast of what's coming up in the stock market in the investment policy committee notes, and that goes to every one of the largest institutions on the globe. And they make they do a conference call for that. They have a video TV thing that they do for that. So in any case, it's a validation of the work that we do. So while the breadth and scope of our research followers is quite impressive, what I'm not trying to do is brag about it. What I'm trying to impart to you is that our methods and practices are legit, they work, and you too can benefit from the same type of research that before now we exclusively did in the institutional world, dealing with the Standard & Poor's and the investment bank types. So we built i10Research on the exact products and practices that we're now going to bring to individual traders. I think it was mentioned that we have not done the TradingPub before, and that's because we have not been in the retail space before. This is going to be something new for us, but we're excited about bringing our stuff to a retail client and retail clients, because we know we have a lot to offer, and the benefits that that we provide to institutions, retail traders can reap the same benefits. So let's get down to a little bit of education here. So what is volume at price? Volume at price is a visual record of the volume traded at each price. If you're a new trader, what that means is that the volume is accumulating not on the bottom of the chart, behind, under each bar. It means it's accumulating on the left-hand scale. As the price trades, it's accumulating volume at each price. And I'll show you a picture here in a minute. But it shows what prices have seen the heaviest traded volume. It's highly effective in identifying support and resistance areas, and it's used in a auction market theory and auction market principles. It's a trading methodology. It's an analysis methodology that is very effective. So it's uniquely useful because volume at price is market-generated information, and I say that because there's a lot of magic that's sold in the internet, in the trading space, and it's kind of promoted as magic, and the logic or mathematics behind it is, if it were to work, it would be magic. But volume at price is market-generated information. It's what the market is doing, and unlike many technical analysis indicators and oscillators, it provides objective information that is both reliable and consistent in its application. I said it before, I'll say it again. This is important. If you're a trader that's looking at markets every day and you need to make trading decisions, you need objective information, you need it to be consistent, you need both the analysis and the application to remain consistent, or you'll never get to consistent results. It just won't happen. So what does volume at price look like? This is a small picture, and you can see that the volume is accumulating on the left-hand edge. It's displayed as a histogram along the price scale, and it builds across the chart as the traded volume occurs at each price. So on the very left-hand side of this chart, when price initially gets into this area, there's no red on this chart. But as it trades up, and then moves sideways, what's happening is all along these lines, the market is accumulating volume, and the volume at price histogram begins building like what you see here. And as the market continues to trade, you can see where it's built some peaks in volume, and we're going to talk about those in just a minute. But that's where the volume shows up using a volume at price tool versus, like I said, just a regular putting volume on a chart. It's going to put it under on the time scale under each bar. So while traditional indicators often are simply derivations of price information, you know, first derivative, second derivative, or some type of mathematical average, volume at price provides unique additional information that is not available to traders that only use traditional technical analysis methods or traditional indicators and oscillators. Here's an example of how to use volume at price. By applying volume profiles to a specific area of the chart, information can be drawn out of that price action that identify areas of support and resistance, which is a first and primary use of using volume at price. And you can see on the top chart, I have a line drawn vertically that goes to the bottom, and it's supposed to denote the same moment in time. And what you can see is on the top chart, there's a pronounced area of high volume right here. And that's been accumulated over a period of time. The dates on this chart are going back, you know, this is a few months worth of data. But you can see that a price level has been clearly defined. Then subsequently, the market trades lower, and when it hits that price level, that marks an area of support. And the market continues higher. This is one benefit of being able to see volume at price information. Without volume at price information, you can learn to see what is effectively this same area, but if you want to know specifically, without any question, what is a high volume area of support or resistance, using a volume profile is the way to do it. HVAs, the high volume areas, that's what we were just looking at. The high volume area is the area of heaviest volume within a volume profile histogram. The location of HVAs and the price action around HVAs are determinants in trade setups. That means setting your entry, setting your stops, and setting your targets. And you do that by using volume at price profiles, and you can use it on multiple time frames, and I'll show that a little bit later as well. But that forms your expectation regarding subsequent price action. On the chart above, when we had that pronounced area of high volume and the market came back to test that area, the immediate expectation regarding what's going to happen next is that that area was support and it would be defended. Now, if the market didn't do that, that would tell us something significant as well, and likely would result in a losing trade or a scratch, depending on exactly how it reacted at that area. But it's a determinant in how you set up your trades, how you manage your trades, how you manage your expectations of future price action, and in determining, obviously, the trend of the market, because as the market trends in one direction, it's going to build volume at price peaks all along the way. So HVAs are built as the market trades over time. The HVAs that are built by price action are known, and if you keep track of these, when price reaches an area of previous high volume, traders with visibility to this information have an expectation that is strongly rooted in valid market-generated data and a proven methodology, that being auction market theory. So volume at price provides a superior lens through which to view the market and make determinations about what is likely to happen next. A 200-point drop in the S&P that preceded a 400-point rally all looks very logical when viewed using the lens of volume at price. This is a kind of an old slide. It's 2009 through early 2013. But one thing you'll notice is that by summertime, right here, this volume profile looked exactly as you see it. This red box that is around the volume profile, that's showing what area that this profile is being calculated over, which means when it gets to this area right here, these bars are weekly bars, and you can count how many weekly bars there are from up where it started moving lower to where it took multiple jabs into this area, and this is a lot of weeks, folks. And this volume profile was known for months in advance that this was the primary area of support. Before the market broke lower in any way, shape, or form, this area was known, and for the traders in the know, institutions and people with money to move, they know exactly where this is. And if the market is careening downward, they're not going to get involved until this area. And you can see that's exactly what happened. They started accumulating at the first jab, and then they let off. When it came back in, they're accumulating more, and then continued to drive the market higher. And that brings us to the current state of things at new all-time highs. So using volume at price, it's useful in all time frames. Volume at price is applicable and useful at all degrees of scale. It can be used at weekly charts like we just looked at, everything down to a 5-minute chart, and all time frames in between. The picture on the right is showing a 15-minute chart, and it's showing kind of a similar same circumstance, but just opposite of what the earlier one was showing a level of support in a long on a weekly chart. This is showing a 15-minute chart, and it's showing the E-mini S&P. It trades lower, and then it goes on a rally, but the rally is rejected, and it's rejected from an area of high volume resistance. And this is something else that I mentioned that is critical when looking at volume at price information, multiple time frame analysis. So if you perform this type of analysis in multiple time frames, it allows you to integrate the broad view of what the market is doing with the immediate movements at a more granular level. And the example that I'm showing here is showing a consolidation on a daily chart. You can see where the highs are, you can see where the lowest low is, and you can see how much time has been spent in this range. Then on the right, what you're seeing is the exact day where this chart is the right, what looks like the right-hand edge of the chart that's on the left. You can see on this day it's trading near that high. So you know there's a large degree level of resistance at the top of the chart, and it starts to trade lower. And when it comes back up to test that area of high volume, that's a level to enter shorts or to have resting shorts. And your stop goes above it, and you can see the market trades lower. But this is integrating two time frames, a daily and a 15-minute. This is not the only way, the only time frames and the only way to do this, but it's a very good example of multiple time frame analysis. And the reason that you do multiple time frame analysis is so you can take positions that not only have favorable odds of success, but also have very high risk to reward metrics. And the idea being that you can set up a trade that is a high probability trade on a lower time frame in a spot where on a higher degree time frame you have an expectation. And if your expectation proves to be correct, you'll get paid a lot more than you're going to need to risk to find out if you're right or not. And from the standpoint of what's the easiest way to become a successful trader, if there is an easy way, it's identifying high reward to risk trades. That way, if you win 4 or 5 times out of 10, if you have your risk reward metrics such that you're allowed to, you're a winning trader with just 4 to 5 winning trades, it's much easier than if you trade a methodology where you have to bat 70% or 80% on all your trades, and you can easily give it all back if you ever dip below a 75% win rate. That's a hard way to make money consistently. So using volume at price and HVAs to find support and resistance is very reliable, and the levels remain consistent as you step forward in time. It removes the ambiguity that goes along with other popular methods of finding support and resistance, like Fibonacci, Bollinger Bands, moving averages. The list is longer, but the idea is the same. As the market continues to trade higher, Fibonacci levels continue to adjust. They're different today than they were yesterday, and they'll be different tomorrow. Same thing with Bollinger Bands and moving averages. Volume at price in the high volume areas, they don't do that. Once they're established, they're there, and that's good because they're reliable and they remain where they're at once they're established. So in our research, we use volume at price information for all the reasons that I just was talking about, along with the principles of auction market theory to formulate our trading analysis and market opinions. When institutions utilize our research, or when you utilize our research in your trading, you know that you're using highly reliable institutional level analysis and research to assist you in making trading decisions. Here's a look at what we currently are bringing to market. We have a U.S. futures, European futures, daily reports, and U.S. futures, and a Forex weekly report. Now, we cover a lot of markets. On the daily reports, we cover the liquid futures, stock index futures, E-mini S&P, E-mini NASDAQ, mini Russell, the Euro FX futures, crude oil, gold, 30-year and 10-year, and we release that every day before the New York opening. Similarly, European futures is released before the European Open, covers the DJ Stocks 50, the DAX, the FTSE, the Bund and the Bobble. The weekly report is more all-encompassing from a futures perspective. There's additional currency future pairs in there, British pound, Canadian dollar, yen, as well as the dollar index. And then we have instead of just gold, we include silver and copper. For energies, we include natural gas and heating oil additionally. We have ag products that we have in the weekly report. If you're a corn trader or soybean trader, we cover that, as well as the meats, live cattle, and lean hogs. The G7 Forex is a Forex report rather than a futures report, and you can see we cover all the major currency pairs, and that's released every week on Monday. So our subscribers receive comprehensive volume at price market analysis delivered each day. We give trading bias for the intraday and swing traders. We provide the specific and robust levels of support and resistance, along with our precise trade recommendations. That's entry, stops, and targets. And we include with that daily portfolio summaries and trade updates and alerts that we send out outside of the regular report schedules. So the bottom line is, if you're a novice trader and you're seeking a valid and proven approach to develop a trading plan around, then you're in the right place. Or if you're an experienced trader and you're looking for something to help as a decision support tool to incorporate into your trading plan to increase your consistency and increase your edge, you're also in the right place. So this is an opportunity for you to get access to institutional quality research without an institutional price tag. And the best part is, we're going to let the attendees of this Trade-A-Thon try us out totally risk-free. So we have a special link set up that provides a deep discount on our reports and services. Everything that you'll see once you go to the subscribe page is automatically comes with 30 days free, so you can see the goods and you can experience the value before you're charged a single penny. I'm a firm believer that traders are some of the smartest people around, and they can smell in short order what's something that's legit and what's something that's BS. And so this is our way of letting you give us that sniff test, and I know what side of the fence that's going to land on. So with that, I'm going to have David come back on, and I'm going to have him review some of our trading reports and explain a little bit more. As a subscriber, when you receive these reports, what you should be looking at, how you should use them. What is it that they're telling you? They're very specific, but in order to just kind of show you what we have on offer, David's gonna take over the presentation here, and he's gonna go over in more detail and show you the reports and show you how to use them and talk a little bit more about all that. So, David, you ready to go? You want me to?
Yes, hi, back. Can everybody hear me okay? Mic test, quick mic test. Just let me know if you can hear me and let me know if you can see everything on the screen. Good, good. The screen's visible? All right, good, good. Ken, just to answer your question about volume profiles based on life of contract, the best thing about a volume profile is you can pick what data you want to analyze. So you may want to analyze the life of an entire contract. You may want to analyze one specific day, one specific week. You may want to analyze 3 months on a weekly chart. So the beauty of it is that you can adjust what you want to look for. Now the key with everything is how to adjust your profiles to be able to analyze what exactly you're going to look for. And that obviously is the harder part of the equation. But after I go through this, I'll punch up a couple of charts, Kenneth, and I'll show you exactly what I mean. Okay. This guy on the screen is not me. I have felt this way before many times in the past, and I'm sure people here have as well. But the bottom line is this type of situation and this type of reaction only comes from indecision, confusion, being nervous, not knowing what to do. When you're trading in the market, and I know a lot of you have heard this before, there are no certainties in the market, there's only probabilities. And the highest possible high probability trade starts with the mindset and the very basic rules of A, in an uptrend, don't be short. In a downtrend, don't be long. Very simple. In a single time frame concept, okay, the markets are either balanced, where it's trading sideways, or rotational, okay, where supply is balanced here and meets all the buy and sell needs of all the traders in this time frame, meaning the buying and the selling are of the same consequence, or markets are imbalanced. But markets are never balanced and imbalanced at the same time. That's a very important thing to understand. Okay, and when a market's in balance, you have either more buying or more selling and buying, and that's when you tend to get vertical or trending moves. Okay, and this is where supply is imbalanced and cannot meet the needs of all traders at this specific time frame. Now, the key concept with all of this, and we're gonna keep saying this over and over again, success in trading is dependent on traders being able to accurately differentiate between these dominant phases of market movement with near certainty. What does that mean? It means that when you look at a chart or you look at a market, it's very important. There's only two things it could be doing. It's either trading sideways, rotationally balanced, whatever lingo you're used to, or it's trending, trading vertical. That's it. It only can be doing one of two things. But the thing is it can't be doing it at the same time. They are mutually exclusive. It's a very important thing to understand. Now, let's take a look at balanced and imbalanced markets and how they look. A balanced market, again, trades rotationally. Okay, an imbalanced market will show you an imbalance down where you have more sellers than buyers. Conversely, markets eventually move back into balance, then back into imbalance up, or an imbalance down, depending on from where, and then back into balance. It basically is just an even ebb of flow of balance to imbalance to balance to imbalance. It's a very, very simple way of looking at the market. And when you look at the market as far as candlesticks or bar charts like we're used to, you know, a slow market is slow overlapping bars, where a down market or an up market is fast, non-overlapping bars, clean move down, back down to slow overlapping bars, and then again to fast non-overlapping bars, clean moves ups, and then again back to slow over bars, lapping bars. It's just a nice flow, endless ebb and flow of balance to imbalance. We have a phrase here. Balance leads to imbalance, leads to back to balance, leads to imbalance, okay? So when I'm in a balanced market, okay, I know the next move is an imbalance move. When I'm in an imbalanced market, I know the next move is eventually going to be a balanced move. Okay, we want to trade the imbalanced parts of the market. We don't really want to trade the balanced parts of the market, and we'll go into that in a little more detail after. Fair versus unfair price. Now, anybody who's used to volume profile and market profile terminology are familiar with what fair and unfair volume price is in a balanced market and who has the advantages. Typically in a balanced market, the value area, which is seen here, typically has most of the trades, roughly about 70-72% of the trades. And again, it's inclusive to any specific time frame that you're looking at. On the top are the advantages to the sellers. Professional sellers are selling in this area where novices are buyers. They're tending to buy on here looking for that breakout to the upside, but what happens is when supply dries up, price will then move back to the bottom of that profile, just like it does right here. And at the bottom of these profiles, you have the advantage to the buyers. Professional buyers are buying in this area where the novice sellers tend to sell in this area looking for that breakdown. And that's why most novice traders tend to get chopped up a lot in a rotational market. And when they're in a trending market, they don't realize they're in a trending market and they keep fighting that trend. These are the two biggest problems we see with retail traders. Market formation characteristics. This goes back to market profile. This is typically what a market profile chart would look like and what Stottlemyre started to include in his analysis back in the early to mid 80s. But a balanced market is a fat profile, and you know, when we look at volume profile, we'll see that a little more differently. But what it is you have a balanced market. What is a balanced market? It's rotational. It's horizontal. The profiles are fat. Okay, it accommodates both buyers and sellers, means there's equal amount of buying and selling at the time, and a lot of the times the movement through these areas are very slow. Or you get into a vertical market where the profiles are very thin. It's directional. It's vertical. The volume profiles are skinny. There's no volume accumulating in areas. That's how you know you're in a trending market. Going back to what we said a couple of minutes ago, it's very important to understand whether you're in a trending market, aka trending vertical, or in a balanced type of market. Once you're able to understand what type of market you're in, you'll then be able to eliminate one side of that market and make your trading a lot easier. And I'll show you how to do that in a little bit. Now, horizontal development versus vertical minus development. This is a very important concept in volume and price. Efficient price development that accommodates both sides of the trade over time and produces a balanced profile. But in B, inefficient price development that move vertically higher and faster, accommodating only one side of the trade, result in skip development in the lower portion of the profile. We call this area minus development. It's a hole in the market. It's where volume has never accumulated. When we start to look at a couple of charts in a few minutes, you'll see exactly what I'm talking about. But what we like to do is we like to trade through these areas of minus development. And markets will trade relatively fast through these areas, these holes of minus development, and between the areas of horizontal development. Market profile, which is very similar to volume and price, illuminates these holes, which help traders prepare and for relatively fast and vertical moves. Again, we want to trade the fast and vertical moves. We don't want to mess around with the tight horizontal stuff, looking or guessing whether it's going to break up or down. It's not the proper way to trade. We want to react. We don't want to guess. React to price action. Price breaks out of a horizontal development to the upside, go long. Conversely, breaks down, go short. But the key is to be able to recognize the market, take advantage, get good entries, and know where to put your stops. The most profitable trades you're going to have and the quickest amount of time are when price moves through these minus development holes. And volume at price will allow you to illustrate where those holes are in the market. Trading vertical moves into holes has higher reward to risk than trading horizontal moves of the same security in the same time frame provided. Of course, that's a trader that's on the right side of the movement. So what that basically means is that when you have a trade that's a breakout of a horizontal development, your risk reward or your reward to risk is much better than when you're going to be trading a horizontal market. Because if you're trading a horizontal market and you're buying support, your limit to the upside is horizontal resistance and vice versa. When you're trading vertical, you have a much better risk to reward type of trade. And that's what we look for, high reward to risk type of trades. All right, fast to slow, slow to fast, market formations and movements. This is an example of markets moving fast to slow. Here's a market moving fast to slow, but except on the downside. A balanced market, slow to fast, and then back to slow. You have a balanced market that goes into imbalance and then back into balance. Remember what we said earlier. Balance leads to imbalance, leads back to balance, leads to imbalance. It's a constant ebb and flow of information. Now, the key concept is markets will trade vertically and fast between these periods of horizontal development, and volume at price vastly simplifies market profile. Like I mentioned before, market profile can be very difficult to understand. It's a bunch of letters determined at a specific time of day. It doesn't go over a typical chart like a candle chart or a bar chart. It's something that we're just not used to seeing, and the learning curve is tremendous. That's why market profile kind of didn't pick up in the 80s and 90s, but now that you have more trading platforms or more information out there, and also the addition of volume at price, it makes understanding market profile much easier. Now, managing trading risk with simplified market profile. This simplified and objective method allows us to risk manage our trades in several ways. We're looking for basically 3 to 4 to 1 reward to risk trades. We're not interested in 1-to-1 trades. The real money is made when you can make 3, 4, 5, 6 to 1 on your trades. Okay? We want to help traders eliminate from consideration one side of the market where price has very low odds of going. So, a lot of times traders look at the market and they say to themselves, should I buy here or should I sell? Well, that should never, ever, ever be your decision. Your decision should be only either, should I buy or do nothing, or should I sell and do nothing? Okay, what we do and what volume at price does, it helps you eliminate one side of the market to help you make that decision a little easier. Now, it may seem like a minuscule thing to think about, but you know what? If you can eliminate either the short or the long side of the market immediately, you'd be surprised how much easier that makes your trading decision. Okay, and it also keeps you on the right side of the market, which is the most problem of a lot of traders. You want to follow specific trading rules, okay, based on indications from our trading tools, which remove most of the burden of past price, volume, and volatility analysis. It means that you want to be able to act and react to what you see. There's no guessing involved. There's just analysis of what's done and to go with the trend, to buy when it says to buy, to short when it says to short, and to stay rotational when it says to stay rotational. All right, we're going to just stop that here. And now we're going to take a look. I'm just going to stop the screen for a second. And now let's bring up some of our reports to get a little idea. And hold on. It's going again. It did not come up for some reason. Hold on. Let's try that again. 1, 2, 1. There we go. All right, like Aaron mentioned to you before, we have 4 standard reports that we put out. And as this thing loads into the projection monitor, don't know why this is not coming up. Bear with me. It says it's loading, but it's not coming up for some reason. All right, guys, can you hear me now? Sorry, my audio was off. Testing 1, 2, 3. Testing 1, 2, 3. Okay. Yeah, okay. All right, sorry about that. All right, again, we have 4 major reports that we put out for the FX and the futures, 2 weekly reports and 2 daily reports. This is the FX weekly report, and this is basically how it looks. Front page, in addition, you will get just a highlight page. It's basically just a list of the foreign exchange pairs. It'll give a bias, a little arrow, and just some comments. The comments could be the bias is neutral, we're doing nothing, it's trending higher, stay long, it's trending lower. If we've got a trade recommendation out, if we hit a stop or we're adjusting anything at, we'll adjust it in the comments. The reason for this 1 page is so for some of you that you just want to have a quick shot glance of something of the report to get what information you want, this gives you the highlighted information of everything's in the report. That way you have something handy. It's color-coded with a bias, and it gives you a comment of exactly what you need to know, the most important thing. All right? Now, this report comes out once a week. We do put trading signals out on our research, okay? We are not a so-called AKA trading signal company. We are a research company that puts out trading recommendations. And we do it a little bit differently than most people. We're not going to SMS you or text you. Everything is done by email. Everything is done in the report. Every Monday you will get part of this report, a portfolio summary, which will have the current open orders, whatever open orders we may have at that time, open positions, whatever open positions we may have. This report's a couple of weeks old, so don't go trading these. These are probably old trades and recently closed. Okay, this gives you an idea every Monday, okay, what exactly we have. Okay, that way you'll absolutely be able to check your portfolio and check your trading platform that you've closed everything you should have, you have open everything that you should have, you've adjusted your stop properly. This tells you how many points were up or down or how many percentage of the move are underlying. We're not caring about how many dollars per pip we made. We basically judge everything on how many pips and the percentage move of the underlying. Typically, we like to look for at least 2 to 3% moves in the underlying. In the spot FX market, that tends to be a little lower. The commodity futures, it's much easier to get a 5, 6, 7, 8% move sometimes, which is much more difficult and takes a lot longer on the FX side. Now, on the FX report, you will get this every week. The good news is that the report comes out on Monday, but the rest of the days for the week at the end of the day, you will get a one-page portfolio summary update to update you, okay, on everything that happened that day, or just to make sure that every day you understand what we have open, what we have still working, and what has been recently closed. All right, and you usually get that by 4, 5, 6 o'clock around there Eastern time. All right, let's take a look at the charts. This is what the report looks like. For each spot currency pair or futures commodity, you'll have a chart like this, okay, with an explanation above. The explanation above is basically just telling you exactly what we're thinking here and what you should be doing. Now, if you notice, a lot of times you'll read a research report, and the research report will go on and paragraphs of stuff. Well, we aim to eliminate that. We aim to pick out exactly what you need. We want you to read this report and not waste time with useful information or opinions. So when you read a blurb above a report or a chart, okay, that blurb is going to be straight to the point. We're bullish here, we're bearish here, we're long here, we're short here, the trade's on, the trade's off, stopped out, whatever it may be. It goes right to the point. That way you take a look at the Aussie USD, you read it, you know exactly what's going on. Now every chart will look like this. There will be a volume at price tool right on it, okay, and we annotate the charts with high levels of support and resistance, highlighted by these high volume areas of the volume profile. But we also make 3 annotations, okay? And every single chart and any single report, whether it's a weekly or a daily, will have this. It will have a long favored green, it will have a rotational blue with arrows, and it will have a red where shorts are favored. And it's very simple. Above where longs are favored, you only want to go long. We talked about eliminate one side of the market before. Well, if I'm trading above this level right here, I can eliminate the short side of the market, okay? And I want to go long. Chances are, especially on the weekly reports, you will get a trade recommendation, okay, sent right to your email with a specific trade recommendation, long, short, entry, stops, and targets. And typically you have plenty of time to get into these. These are not day trading ideas. These are swing trading ideas. So, you know, if you're a half an hour late to the party, and maybe you get a little better price, maybe you get a little worse price, maybe it hasn't hit the limit price yet, but most orders are limits orders. You have plenty of time to get in. But the bottom line is, when your longs are favored, get long. Do not get short. And you want to sell into the targets that we have initiated. So we have a 95.39 level here, a 97.53. Those are the levels that you want to start taking profits at. Now, if you're a contra trader and you want to take a little nibble on the short side at one of these levels, that would be the only time, if you want to dabble a little bit, shorting and going contra to what the market is saying. But understand, it's only for a scalp. You'll never see a trade come out of our mouths or our portfolio recommendations from that. That's just not what we do. We're looking for bigger moves. This was mainly meant for institutional trading. So again, when price moves above these long areas, you want to get long and take it up to those high level areas. Same for the shorts. Price breaks into the short levels, you want to get short and take it into these short levels, 90.77, 89.06. Chances are we would have explained everything to you above. Now, rotational. How do you trade rotational markets? Real easy. What do you do in rotational markets? You short tops, you buy bottoms. So if the market's rotational, I'm here at the bottom, I can get long here and look to target it up to the top of the rotation. Okay, if this fails as a long and we drop below here, I can then take a small stop and then I can get short. The best thing about volume and price analysis is that, A, when you take a good setup, a high percentage setup, and it fails, the majority of the time, the opposite trade, the reverse trade, is not only a high percentage setup, it's probably a higher percentage setup than the original trade that you took. Okay, so what do I mean by that? If you buy rotational lows and it fails, you can get stopped out and take a short, okay, down to these levels. This short trade will probably be a higher percentage trade than the original trade. Vice versa. If you go up here and you break out and it fails and it moves back into rotational highs, okay, you can then take a small stop on your sales, and then markets trading at rotational highs, short it right back to rotational lows. So as you can see, these charts give you a roadmap okay, of exactly what you want to do. All right. Here's the US dollar, Swiss franc. Okay. We talked about a fat profile. This is a perfect example of a fat profile. Markets in balance. 70% of the information in the trades are trading within this area. Okay. Once we analyze what rotational support was, as you can see, price was below rotational support for a while, but could never get any selling pressure to the downside. So if you got short and you were short under here looking for a big move down, you wound up probably taking a small little stop. But what happens here now is that since the short trade is no good, price has now moved back into this projected rotational range. Well, what do you do at the bottom of a rotation? You buy at the bottom of a rotation, targeting the top of the rotation. So the way these charts are laid out and reports are laid out, they're basically laid out with the intention of giving you trading signals ahead of the market action. It's also there to give you the adverse scenario. A lot of times a trader research might say, buy here, buy here. Well, what do I do if I'm wrong? Okay, do I sit back and don't trade that day anymore or take the week off? This will give you the adverse scenario so you can trade all levels where the market is. All right, so that's the US dollar report. Here, we have the futures report, weekly report. Same thing as the FX report. You'll get a highlight page in the beginning, and as you can see, we cover all the major markets in the weekly report. The major indices, currencies, interest rates, energies, metals, agriculturals, and the hogs and the cattle. Okay, all these come with trading biases, comments, okay, and trading recommendations. So for a futures client who can swing trade, who can handle the overnight margin, you're basically having an inline signal service provided with your research. Now, the difference between a weekly report on the FX and a weekly report on the futures, it's basically the same, but the main difference is money, account size. In the FX markets, you can trade with a small account size because the leverage is just as high, but your margins are the same whether you trade intraday or overnight. That's not the case in the futures markets. You need a lot more money to hold these positions overnight. So therefore, if you're swinging commodity futures, you need at least a minimum of a $10,000 to $15,000 account just so you can trade 2 to 3, maybe 4 things at a time. Obviously, a bigger account will be better. An FX account weekly, you could swing trade an FX account with $500 if you want. Okay, that's the beauty of that. It allows smaller traders with smaller accounts to get involved in the market and swing trade, get involved in trends. We don't day trade the FX markets. Okay, originally our recommendations and research were meant for institutional clients who are not interested in the day trading. Well, it's our opinion is that if you don't need to day trade, why do it? Okay, now the futures, there's some big commodities and big futures contracts that are very good to day trade, and we do those on the commodities. But in the FX markets, we're looking to catch those 2 to 3 day trends, maybe 2 to 3 week trends. If you're lucky, like a couple of years ago when the Japanese yen and the Swiss franc were trending like crazy, you were able to stay in those things for 3-4 months and make your year just in those trades. Okay, so again, the futures and the FX weekly reports are going to be looking the same. Okay, volume profiles built on the charts, and as you can see with volume at price, it goes right over a chart that you're used to seeing, a bar chart, a candlestick chart, if you use a line chart, whatever you use. The biggest problem about market profile, it's very difficult to understand what you're looking at, and the learning curve is much higher. So again, here, as you can see, each chart is outlined where we favor longs, where we favor shorts, and where we favor rotational action. So we're basically giving you the trading signals ahead and basically saying, hey, here's the roadmap. When price trades here, go long. When it trades here, go short. When it's here, it's rotational. This is where you should be placing your stops. Now, on the weekly charts, you'll get exactly that information. Okay, the daily charts, we do things a little bit differently. Okay, and here's the futures daily report. U.S. futures, and we put out a U.S. futures and a European report, okay? The U.S. futures don't come with actual trade recommendations like the daily and the weeklies do. The weeklies are more for portfolio, and it's much easier to disseminate that type of information. But intraday, what we're looking to do is we're kind of looking to give you that roadmap to trade, give you those important areas where you should be trading. The problem is with most retail traders, they don't know which side of the market to be on. They don't know what type of market they're going to be on. They're trading off 5 3-minute to 100 tick charts, and they're trading in very small time frames, and they're getting tons of signals on these timing indicators that they have. And what happens is they wind up, they're sloshing themselves out of the market. What we do is we identify all the important levels of support and resistance for you. So that way, when you sit down to trade, you already should know what levels you should be trading at. Okay, this is the front page of the report. It's pivot points. These are proprietary pivot points. Everybody's traded pivots before. These are very good levels to use in conjunction with the important levels of support and resistance. And you could put these directly on your computer screen and charts every morning. And again, they're a very good guide in determining not only intraday trend, but also helping you making timing decisions around your high-level HVA support and resistance. We also have a little page here where we explain pivot points. It's in every report, so just in case you want to go and get a little refresher on how to use this stuff, it's right here in every daily report, page 2, and it'll give you information on exactly what we feel and where price is in accordance to those different pivot points. Okay, but as you get into the reports look the same as the weekly reports, except they're daily reports. The weekly reports are on daily time frames. They're for more longer term type of stuff, couple of days, couple of weeks. The daily charts are 60-minute charts or 240-minute charts. The implicit use of these things is the day trade. Find out where the most important levels of support and resistance are. Here's the ES for today. Actually, I don't think this was today's report. This was, yeah, it was this morning's report. Okay, so what happened today is, as you can see initially yesterday, we had some nice support from the previous high volume area and we got a bounce. But today we traded back into the 1936 level. I think we actually traded a little bit lower even, maybe to the 33. But these areas of support and resistance are targets, okay? And once we get behind there, and once we get into these levels, we know exactly what to do. Again, when price gets above where longs are favored, get long. Set your stops just below. Shorts, price gets into these short levels. Get short. Stops should be right above. Your targets are plenty defined. Okay, now, what happens if you're in a short trade or in a long trade and it gets stopped out? Well, any long trade or short trade that's stopped out usually will put that price back into rotation, because between rotation you have long and short. So if you're short here and it fails, okay, price will go into the bottom of the rotation. If you're long and price fails, price will then move to the top of the rotation. Okay, so the low of today on the S&Ps was 1921 on the S&P. So if you got short, we're told to get short below 1936, well, where's the low of the day? Right 1920 to 22, or high volume area. All right, when I pick up the charts in a couple of minutes, we'll take a look at that exactly. Okay, but one thing I want to point out, we talked about what holes in the market look like. Hole in the market. You see this? A hole in the market where volume did not accumulate. So what happened? Volume and price move very quickly through these areas of volume or minus development. This is what makes volume and price analysis so predictable. When price is up here, I know that if price ever gets down into here, I know to short it and it will move quickly into those levels. And you know what? What happened is, a few days later, today, that's what happened. Okay, it gives you major levels and major interest of predictability, which most traditional indicators just can't do. Now, if you've got some good timing indicators that you're using, and we've seen some good stuff from speakers today about different indicators that they use and maybe timing things in shorter time frames. If you've got something good that you like to use and you're successful with, chances are around these levels, those will be very high probability trades. Okay. And again, this is the daily report. Okay, we do it for the NQ. As you can see, everything is outlined the same. Trend lines, rotational, longs, where support and resistance. As you can see from our charts, there are no indicators. Okay, we do not believe in indicators. We are not indicator people. I've used all the indicators that you can possibly imagine over the years. I used to have 20 indicators on my charts with 20 different time frames. It doesn't work, okay? It didn't work for us, and it doesn't work for a lot of people. I used to laugh at people that used to say, hey, the only thing that's important is volume and price action. I used to laugh at them. You know what? Those guys are right. Volume at price and price action is all that matters. So what most people fail to do is that when they sit down to the computer every day, they fail to do their research. They fail to analyze the markets. They punch up their 5 and their 1 minute chart and they start day trading. Well, the problem is you got to do your homework. This is a business. You got to trade it like a business. The good news is we do your homework for you. We analyze the market. We put out a research report. We put out trading calls. You do not need to trade alone. Okay? Everybody thinks that they need to trade alone. They need to find a system and need to be on their own. That is not the case. We deal with investment advisors, money managers, hedge funds, CTAs, guys who are managing multi-million dollars, who look to advisors and research companies for advice on managing their money. So if a high-level hedge fund manager has no problem getting advice from research or other third party, then a retail trader who's either successful, break even, or mildly successful shouldn't have any problem with it either. Okay? So again, all these charts and all these platforms, okay, will be the same. Every chart will be annotated the same with the same thing, shorts, rotational, and longs. Okay? The last thing that we put out, and it looks like something like this, we put out a trade update. So let's say there's a new trade. It's weekly reports coming on Monday, but it's Wednesday. There's a new trade. Okay? Now, we have a bunch of these on here, but this is the examples that we'll give. We'll put out a report just like this. We'll send it right to you. We'll tell you, hey, new order was filled. Or, hey, we just closed the position. This was what happened. We're adjusting a stop. We're long USD JPY. It's in profits. We want to adjust the stop. Target adjustment. Okay, maybe a new order. Okay, new order announced. US dollar Canadian. Go long at 1082. Target this. Stop here. Okay, most of these orders that you will get will be limit orders. Occasionally we'll say market, just go to the market, we'll give a price. Sometimes you get a little better, sometimes you get a little worse. We are not trading for 10, 15 pips, it doesn't matter. We are trading for 1, 2, 3, 400 pips at a time. So getting into a trade 15 points higher, 15 points lower means absolutely nothing. The point is that you'll have access to all of our research, our daily and our weekly. You'll have access to our trading calls. You'll have access to our analysts through either email, instant message. You'll be able to ask us questions at any time. Okay. I think they just posted the link in the room. If anybody hasn't seen it, i10trading.com/pub. All right, that gives you all the information. I think, let me see if I have it here. You can get it there as well. And actually, let's put it up. So here we go. Okay. Why is this so valuable? All right, as Aaron mentioned to you, typically we've only dealt with institutional clients. We do a lot of decision support consultations with clients, meaning they pay us for our research, but what they really pay us is for our decision support. We also offer them subscriptions, okay? But obviously the subscription prices that we offer to institutional clients are not proper for retail clients. The value of the report that we send out is determined on who's using it. A guy who has a $15,000 account should not be charged the same amount for the report as a guy who's managing $100 million in broker assets, okay? And we understand that. So what we basically did is we've made a retail pricing scale, and it's a dramatic drop-off from what we're used to charging. So for full access, all daily and weekly charts, okay, $299 a month, which is typically $3,588 a quarter, okay? We give you the U.S. Futures Daily Report alone if you're just a futures trader. That's only $97 a month. Typically, it would be $747 a quarter. European Futures Daily Report, same thing, $97 a month, usually $747 a quarter. And then the U.S. Futures Weekly Report and the G7 Forex Weekly Report, $139 a month, typically $1,000, over $1,000 a quarter, which is a 60% discount, okay? Now, we want you guys to understand our research. We want you to take a look at it. Therefore, we are offering you guys a 30-day risk-free trial, okay? Take the research, use it, get it for 30 days, learn, watch it, analyze it, ask questions, learn what you're doing. We want you to understand, and that's why we're giving it to you for 30 days and not just 2 weeks, because we want you to understand how to use this stuff. Because once you understand how to use this stuff, we are very confident that it will show the same type of value in your trading and add the same value as it does to our trading, not only for the clients that we advise, for the clients that we manage as well. Okay? So just go to that link and you can get the 30-day trial from there, and all the pricing is there. So if you want, just save that link. And since we're running out of time, let's open everything up to questions now. And I know that went a little longer than I expected. I like to talk, so that's nothing new. Yeah, 30 days. I mean, we want you to understand it. It's no use to anybody to give it to you for a week. I'd rather have it let it you for 30 days and then have you as a client for 10 years. Okay, 2-week free trial. You know, we all sign up for those. But here, take it for 30 days. Read it, analyze it. At the end of the day, compare the end of the day action to what the report says in the morning. Watch the trading calls. You know, the weekly reports come out once a week. So at least here, you get 4 reports instead of 2 reports. If you want access to our archive reports, we'll do that as well. Feel free to call us. Anything that you guys need to do to understand and let us help you understand this research, I promise you this will truly increase your profitability, and it will put you on a better path to your goals. How to read trending or non-trending day. Okay, well, there's 2 ways to do it. First of all, the pivot points are actually a very good way to understand whether it's a trending day or not. Typically, trending days, okay, the resistance and support 1 levels, when you get outside of these levels, you're typically trending for the day. Okay, that means when you get out of these levels above the resistance 1 level and below the support 1 level, you want to be going with the trend. It's a trending type of day. Okay, but don't forget, always be cognizant of what the longer term trend is, because if you're in a 60-minute trend or you're in a bull trend on the longer term charts, your attitude should be to buy key support levels in the morning, not to go short. So it's also having the attitude, hey, the longer term charts are in a bullish level. So if I come to you and you're trading the ES during the day and your ES is in bullish territory, you're going to come in and you're only going to have a bullish bias until that changes. So how do you know? The research will tell you. Where is price action today on the ES? Today it started rotational. It started at the top of the rotation. What happened? It failed to get over 1950 and it dropped all the way down to these lower levels, just like we were anticipating for the past couple of days. If that didn't happen and it went over 1950, we were fully prepared to get long again, and so should you. All right, you're looking at the SPY, and what would you say are the support levels? Look to me, it should fall back to the 89. Well, I don't have the SPYs up, and it depends on what type of time frame you're looking at. But here is the U.S. Futures weekly report for the ES, and this was a couple of last week. So the 1898 and a quarter, 1892 to 1898 is a very important level on the S&P contract. So that would probably be add about 3 points or so for the cash index. So you're probably talking about 1895 to 1898, which is exactly what you said. Okay, here the difference is we're confirming it for you. We're showing you why. We're not just giving you a trading and a signal and opinion. We're showing you why, and we're showing you how we come to that analysis. So that way you can not only earn, but you can learn at the same time. Now, we don't do anything on a quarterly rate for retail. Everything is on a monthly rate. There is no contract. You can cancel at any time. Okay, the difference is we want to give you it for 30 days for free. try it out, learn it. You're going to love it. And once you do that, then we'll put you on a payment plan on a monthly basis. But you can cancel at any time. This is no contract and no quarterly. Now, on the flip side, and we haven't come to this yet with the retail side, but if you're a client with us for 6, 7, 8 months and you want to say, hey, I don't want to pay month to month, can you give me a yearly rate? We'll be more than happy to discuss something like that with you. Why the 1 hour perspective versus market pro 30? It's all a matter of preference, Don. Okay, 30 minutes is typically what market profile has been on. But market profile is more dynamic, where volume at price, we're basically trying to show where the high volume areas are on the longer term charts. Typically a 30 and a 60-minute chart will give you a lot of the same information on market profile. You'll just have to go out a little further on the 30-minute chart. But if you put a 30 and a 1 hour chart together, okay, you will see the difference. You won't see much of a difference as far as the analysis. We do the hourly because we feel that's a higher enough time frame and not too low enough for daily charts to really isolate the institutional volume. Sometimes we'll go to a 240-minute chart. The biggest thing we need to do is we need to isolate the institutional volume. Then you can go to your short-term trading charts, 5 minutes, 3 minutes, and 1 minute charts or tick charts for your timing tools around this area. The bottom line, this gives you the bias in the areas to trade. Then you go ahead and work that plan. All right, I think we're running out of time here. I didn't expect that, but are there any other questions? Oh, okay, yeah. You can get the whole package to start, but when you subscribe for something, you subscribe to what you want to. Yeah, so if you're just a futures trader intraday, it's $97, not the $299. The $299 is if you want all 4 reports. Chances are, and it depends on what type of trader you are. Typically, an FX trader is not a futures trader, but a futures trader is an FX trader. Typically, a day trader is not a swing trader. Typically, a swing trader is not a day trader. So, in general, you'll probably buy the one report that gives you what you do. Now, a good bundle is the weekly and daily futures. Even if you're a swing trading futures trader, the daily report will still give you very good timing tools and timing levels on those spots. So that's something you might want to do. But yeah, you can purchase any subscription that you want. We offer a $299 for all 4, or you can do $97 for just the daily reports, or $139 for just the weekly reports, and that's it. If the asset goes straight up, does it mean there weren't many orders in the area? What it means if something goes straight up is that the supply or the demand is now much greater than the supply. That's really what it is. If you break out into it here, this is the S&P chart. Okay, we went up to what, 1940 or whatever here? So here, this chart, longs favored over 1998. Well, we went up to, I think, 1950 or something. That's a 50-point move and there was the call right here. Go long right above these levels. What happened? Straight up. All right, guys, we're going to wrap this up because we got to get ready for the next speaker. I know we had some extra time, so again, you have the link. We definitely look forward to hearing from you guys, and if you have any questions, all our contact information is there as well. And I just wanted to say thank you to the TradingPub, Yana and Morgan and Raleigh and the guys, Cam. Thank you for having us. We really appreciate it, and we look forward to doing more of these again with you guys in the future.